If you are a doctor or a high income earner, this new tax bill might save you thousands or quietly cost you more. The One Big Beautiful Bill just changed the tax game in a big way with surprise deductions, program cuts, and new rules that impact how much you actually take home. And if this bill didn't pass, well, you were about to pay a lot more in taxes. And most of your colleagues still don't realize it. So let's break it all down from the perspective of someone who lives at the intersection of medicine and money. Today, we're digging into what the One Big Beautiful Bill Act means for high income earners like you and what would have happened if it never passed. Let's start with the good news. First, the tax breaks from 2017 are now permanent. Now, nothing in life is permanent. What they mean by that is that it does not have a defined sunset. And that is why we're exactly here today, because this new bill locks in the lower federal tax rates from 2017 Tax Cuts and Job Act that were set to expire. So that law brought down the top federal rate from 39.6 to 37%. And it adjusted brackets upward so more of your income gets taxed at that lower rate. Now, federal income tax rates will remain 10% to 37%. And you might be asking yourself, well, what if this bill didn't pass? Those lower rates were scheduled to expire in 2026, shifting most tax rates upward. So if you're earning over 200,000 or 300,000, this change could have cost you thousands a year, easily $6,000 to $12,000 and more federal income tax. Second, the pass-through deduction just got better. If you own a business, do 1099 work, receive income as an S corp, or run side ventures like consulting, speaking, or real estate, this deduction can reduce your taxable income significantly. Your qualified business income deduction just increased from 20% to 23%. Now, why does that matter? Let's say you bring in $300,000 in consulting or side hustle profits. That's potentially $69,000 in income that you wouldn't pay taxes on. Now, there is a caveat. This deduction still has income phase outs for specified service trades. And yes, healthcare is one of them. But if you use the right business structure, like an S Corp, or if you have non clinical income, speaking, real estate, online courses, you may be able to work around this phase out. So, with a little strategy, this becomes a powerful tax saving tool. Bottom line is, this change just made entrepreneurship even more rewarding for physicians who diversify their income. Now, the third change in this bill is 100% bonus depreciation for businesses. Honestly, I'm quite excited about this one. Equipment heavy businesses like practices, med spas, or urgent care centers were about to lose 100% expensing for the new equipment and renovations. Without the bill, tax bills for practice owners would have increased as deductions spread out over years instead of being immediate. With the immediate deduction, you could drive a loss on your tax return. And remember that if the asset is sold, however, you will have to pay depreciation recapture. But recapture tax rates are lower than ordinary income rates. So you pick your poison. Fourth, the salt deduction cap just increased. Now let's talk salt. And not the stuff you put on your food, but state and local taxes. That includes your state income taxes, property taxes, and sometimes local or city taxes, depending on where you live. Before this bill, you could only deduct up to $10,000 in salt. That cap was brutal for physicians in high tax states like New York, California, or New Jersey. But now the cap has been raised to $40,000 through 2030. But here's the catch. This benefit phases out for households earning over $500,000. So if you're a dual income household like mine or close to that threshold, then you'll want to pay attention to income timing, bonuses, and deductions. All right, number 5 is the standard deduction increased and even more for seniors. So if you are 65 or older, you now get an extra $6,000 added to your standard deduction. And everyone, regardless of your age, gets a smaller boost. Here's why this is important. The standard deduction essentially shields that amount of your income from taxes. And roughly 90% of Americans take the standard deduction rather than itemizing. So at the start, of 2025. The standard deduction was 30,000 for married couples and 15,000 for individuals. And now, since this bill has passed, here's what it looks like. Single filers, $15,750, and married filing jointly, $31,500. And seniors get even more. So without this bill, everyone would have paid a bit more taxes. And if you somehow get a refund every year, I don't know how, but if you somehow get a refund every year and take the standard deduction, you can expect more money back from the IRS. Now, don't get me wrong, I am excited about the tax breaks, but not everything in this bill is a win. Let's talk about what got cut. And first is Medicaid. Funding is being slashed by 1.2 trillion over the next decade. And if you work in a safety net hospital, in an academic center, or see a lot of Medicaid patients, this could translate to tighter budgets, more burnout, and reduced support, or at its worst, your employer shutting down. Now, this is devastating for the health of our nation and our most vulnerable patients who rely on these supports to exist and to thrive. The second thing that got cut was clean energy tax credits, and they're getting phased out. So we have no more federal incentives for solar panels or electric vehicles after September 30th, 2025. Now, this was part of the whole riff that went on between Elon and Donald Trump. But putting that aside, if you're thinking about grabbing that 7,500 for your EV or a renewable energy credit, now's the time. In fact, this is something that I have been considering for our new home. And if you are interested about the financial decision of this investment, then let me know in the comments and I will make an entire video breaking down the numbers. Now, let's talk about some strange but beneficial changes, I guess. And this is one of the curveballs in the bill, and that is Trump accounts. So, starting in 2025, any baby born in 2025 through 2028 will get a $1,000 governmental seed account. Parents can contribute up to $5,000 per year, and the money grows tax free, kind of like a Roth IRA for kids. The money can be used for education, home buying, or investing. So, yes, if you're planning to grow your family, then this is maybe a benefit worth remembering. Here's a recap of what would have happened if this bill didn't pass. Your income tax rates would have gone up, and the 20% pass through deduction would have disappeared. The $10,000 SALT cap would have remained. Bonus depreciation for business investments would have been phased out. Seniors would have missed out on a new deduction. I mean, all of us get an elevation in the standard deduction, and those Trump accounts for babies, they never would have existed. So, this wasn't just a tax cut. It was a tax cliff that clearly the wealthy wanted to avoid. And as a high income earner who doesn't like to pay taxes and a physician, I have mixed emotions regarding this bill. Our tax dollars, when aligned properly, have major benefits to our nation, our communities, children, and the most vulnerable. So while I am excited to reduce one of the biggest expenses that I pay, I don't want to sacrifice the health of others for my own selfish desires. And as someone who grew up with fewer resources than most, I know firsthand how critical tax-funded programs can be. My family benefited from the initiatives supported by public dollars, programs that helped us to access healthcare, education, and basic needs during difficult seasons. And these safety nets not only provide survival, but they also offer the chance for long-term stability and upward mobility. So that is why I feel so conflicted. This bill offers meaningful tax relief to high earners like myself, especially those of us who own businesses or receive 1099 income. But I worry about what we give up in exchange. The funding cuts to Medicaid, the end of energy credits, the strains that this may place on already under-resourced public systems. Federal income tax isn't just a line item on our paycheck. It is what funds Medicare, Medicaid, Social Security, public health systems, and scientific research. It supports the infrastructure that keeps our cities running, our schools open, and our most vulnerable cared for. So when we reduce revenue without a clear plan for preserving or reinvesting these essential services, we risk undermining the very systems that that supported us and still support millions of Americans today. As a physician, I've seen how social and environmental factors deeply affect a person's health. When people lose access to healthcare, nutritious foods, housing, or safe neighborhoods, their physical and mental health suffers. So as we roll back programs that address these root causes, I worry about the long-term cost to our labor force, our environment, and our collective well-being. So yes, I will plan accordingly to legally and ethically reduce my tax burden because financial stewardship matters. And I want to give you some things that you should do right now. The first is revisit your business structure. Talk to an accountant to understand how these tax benefits could impact you, especially if you're someone who owns a business, has 1099 income. You might find that an S Corp could be valuable, but when you convert to an S Corp, also know if you are a W-2 employee, you may increase some of the Social Security tax that you pay by doing this. So definitely talk this over with your accountant. The next thing that you should do is to track your adjusted gross income. Especially if you're one of those who's hovering near that $500,000, that SALT phase out threshold, maybe a few more dollars into a 403b, solo 401k, or cash balance plan could save you money on taxes by decreasing your adjusted gross income. You also want to plan major purchases like solar panels, EVs, or equipment before the incentives might expire. And if you're having a baby soon, congratulations. And don't forget about those Trump accounts. And most importantly, don't wait until tax season to plan. High earners don't react to taxes, they prepare for them. And with all of your tax savings, please be sure to invest some of that money that you're getting back into your pocket into an organization whose funding has been cut by these and other changes. We as a community have the responsibility to support the most vulnerable. So I am trusting that you will do so. The One Big Beautiful Bill just changed the financial playing field for doctors, professionals, and business owners. And you've got a new opportunity, some new traps, and a limited window for you to make some smart money moves. So if you want to keep more of what you earn, grow it faster, and build a life of financial peace on your terms, then I want you to hit that subscribe button, drop a comment below, and tell me which part of this bill surprised you most or will help you save. Well, I want to thank you for being here, and I'll see you in the next one. Bye-bye.